Terry Blackburn here. I have a property portfolio worth over £10 million. I've built and sold multiple companies, some in seven-figure deals. I wrote two successful books, one won awards all over the world. All of these awards behind me are national and international awards for some of my companies. Coach people one-on-one, and I run masterminds. Now, if you like what I talk about in this session, if you listen to my podcast, you follow us on Instagram, you follow the YouTube page, if you like what I talk about and I resonate with you and you can relate to me, jump on my website, which is terryblackburnproperty.com. All of the different services that I have is on there. I'd love to work with you and I'd love to help you get to where you want to be, whether that's in property, whether that's in business, whether it's in sales, goal setting, whatever it is that you want to achieve and want to learn. I'm your man. Enjoy the rest of the episode and speak soon.
Hi, and welcome to the Rags to Riches show with myself, Terry Blackburn. So, today's episode is all about the 4 serious risks of property investing and how you can safeguard yourself and your business against these risks. So, whether you're just starting off or whether you're relatively experienced in your scaling, I think these are really, really important points. If you're really, really advanced, and you've been doing it for years and years and years, you've got a huge portfolio, you're probably aware of all of these risks. However, I think it's still good to refresh your memory and just put them back on your radar a little bit, even if you are advanced. So, risk number 1, a risk of market volatility and economic changes. Things like recessions, things like crashes, things like the market going down, prices going down, interest rates going up, things that you can't really control, right? Now, this is a risk, of course. Any form of investing, whether it's stocks and shares, pensions, crypto, property, whatever, investing in businesses, there's always a risk, right? And generally, since I think it's the 60s, I think the stat is, the market has went up 7% on average for 50, 60 years, whatever that stat is. So you're only really going to lose money, if you think about it, if you buy too high and you need to sell when the market is down. Even if you buy high, as in you buy the property for maybe more than what it's worth, you make a poor decision, you don't negotiate well, you can only really lose if you're selling that property when the market is down or the same as when you bought it because you bought it too high. But if you hold that asset for 10 years, 20 years, history shows that it'll be worth quite a bit more than what it's worth when you buy it. So you can protect yourself against that by holding the properties longer and having a bit of a longer term mindset. Use property as a long term play. Now, if there's a recession like there was 2008-9, if that happens again, I think properties went down something like 20-30%. The only real way to ride that out is make sure that you're buying at a discount up front to protect yourself against that. You can force the value up by a refurbishment or something. And if you hold the property until the market recovers. Some people have been caught out with that and still get caught out with that because they buy wrong and they're trying to sell at the wrong time. But at the end of the day, we cannot control the market. We can't control economics, what politics goes on, all of that nonsense that I don't take too much notice in. You can't control that, right? All you can control is how you react. And worst case, if you buy at the height of the market and you buy wrong and the market does go down, you've got to have enough cash, enough surplus cash to ride the wave out. That's ultimately. Or you sell at a loss and you can afford to take the hit. That depends on your situation, right? But that's a definite risk that a lot of people are concerned about. But what I would say on this point is don't wait for the recession that some people say it's coming. Robert Kiyosaki's been saying another crash is going to come since 2010. He's been saying it for 14 years. He's going to be right at some point, right? There's other people, all the scaremonger and all that happens online, that the crash is coming, and some investors are just waiting for it to come because they think the crash is going to come, everything's going to go down, I'm going to buy then. But in the meantime, if you listen to Robert Kiyosaki, you've been waiting 10 years. There's a lot of money to be made in 10 years. So I wouldn't be holding off anything. I wouldn't be waiting for anything to happen. I would just make sure that you're buying at the right price and you mitigate the risk. Buying at the right price, being able to ride the storm and effectively keep the property for longer if you need to. And that's all you can really do to protect yourself and not being forced to sell in a down market. And if that applies to you, then you'll be fine, right? You'll be absolutely fine. Buy right. Don't be in a position where it's your only option to sell. Have a bit of a backup plan. Multiple exits helps, but that's risk one. Risk two is a liquidity risk. So I say this a lot because a lot of people are so keen to buy properties. They'll buy anything. They just want properties. They think it's going to be financially, they're going to get to financial freedom in 3 weeks and all that nonsense. But a liquidity risk is real, right? So if you've got, let's say, 100 grand in the bank and you go and spend all of that 100 grand in property investments, it doesn't take very much to put you at financial risk, as in what happens if there's maintenance? What happens if there's an issue, right? We're getting on to point 3 of the tenants and another issue, but like you can't. What happens if, let's say, you spent all that 100 grand in a property, in a couple of property investments, and you have a personal situation that requires money? You can't get the money out of that asset quickly. It's property, right? It's not like stocks where you can liquidate it and sell it within a couple of days, or crypto. Like, your money is generally stuck for a period, and yes, you could auction it, but it's still going to be 60, 90 days until you get your money. So by putting all of your money into property and not keeping a cushion, a safety net, a war chest, then you are putting yourself at a liquidity risk, because you could go skint and then you could be forced to sell the property at a discount and lose even more money. So the solution to that risk is to not spend all of your money on anything, any investment that is. This is not financial advice. I know I can't give financial advice, right? Even though I'm a financial advisor, but I can't give, this isn't advice, this is my opinion. Don't spend all your money in one investment. Keep some back as a safety net. And if you need to be a little, I would always just recommend keeping some liquid cash. People say cash is trash and all of this stuff. You need some cash. Everybody needs some cash. And you need to be able to access some of your assets quickly. So just bear that in mind. The property does put you at a liquidity risk because you can't get the money out straight away if needed. So solution, just don't spend it all. Simple. So risk 3 is a tenant risk. So a load of people have this view, but what happens if you buy a property and the tenant trashes it, the tenant doesn't pay the rent, the tenant this, the tenant that? There's always going to be a risk to property, right? Always. No matter what you do, there's a risk to any type of investing. A tenant is a risk to property. The solutions around that: you can get insurance for things like void periods. You can get insurance if they cause any damage. You can even get insurance to cover eviction costs if needed, right? I don't personally do that because I've had one eviction in 12 years or whatever it is I've been buying properties for. I've had plenty voids and I've had plenty of people damage the property, but I've just never bothered with insurance. Depends on your situation. You can mitigate it with insurance. Part of it is just accept that it's probably going to happen at some point. You're going to definitely have some voids. You're going to definitely have some tenants who damage them a little bit. Hopefully you don't have someone who really, really damages the property, or is an expensive and costly and time draining eviction. I've had one that took about 6 months, about $3,500 from memory it was. It's obviously not nice, but it's part of the game. It's part of the game. But I've got 100 plus tenants, include all the HMO rooms. Like, I've had one eviction. It's not that, it's not that bad. And yes, some people get really unlucky and it's the first property you have to evict the tenant. Things like where you buy affects this. Although even a high-end property, you could end up doing an eviction. But if you're buying in the roughest part of your investment area, the roughest house in the roughest street, with tenants who are a certain profile, you're more likely to get some things like this. Middle of the road, I think, is my sort of strategy. Not the Bronx, as in the worst part of any area. Not the high end either, because the ROI is not good enough. Somewhere in the middle. Between the Bronx and the middle, or the middle, is the sweet spot. I've found anyway. But tenants are a definite risk to property investing. And I advise just maybe some insurance, and just allocate maybe 10% of the annual rent towards something, whether that's a void, whether that's an eviction, whether it's some maintenance, whatever. There's always going to be something, right? It's property. But if you've got enough property, if you've got a large portfolio like I have, it doesn't really matter that much if someone damages the property a little bit, or there's a couple of voids. It doesn't affect cash flow that much when there's enough of it coming in. When it does affect it is if you've only got a handful of property and one or two of them go empty, and then you've got to evict one. Then all of a sudden you're not making any money each month, or you're making a loss. So scaling can de-risk that sort of side of it for sure, because if you've got enough of them, it doesn't really matter too much if you have some problem tenants. So that's risk 3. And risk 4, something that happened a few years back, is tax changes. So God knows what Labour are going to do. God knows what's going to come in the UK. But there used to be a rule where, they brought in a rule a few years ago where if you owned the property personally, you couldn't deduct the mortgage payment as an expense. That really, really hit investors who owned property in their personal name. It really hit them. I sold all the properties that I had in my personal name at that point, 6 years ago, 7 years ago, whatever it was, because I was making a loss on some of these properties. So they may bring in another tax change. They may not, of course. Who knows what the government are going to do? Yeah, but it's a definite risk. But again, don't think, oh, well, if it happens, that's the reason I'm not going to do property, because you don't know. Just like the guys thinking, oh, well, if the recession happens, I'm going to buy then. What happens if it never happens? What happens if it's another 20 years until it happens? What, are you just going to sit on your hands and sit on money in the bank until then? It doesn't make any sense, right? So my view on all of this, tax changes, legislation changes, all of this, adapt and overcome when it happens. When or if it happens, you adapt, you overcome. I've got a good tax advisor, I've got a good accountant. I'll pivot, I'll adapt, I'll change, I'll sell some properties, I'll maneuver it and do something to make them still stack. If that means selling some of the properties, that's what I'll do. If it means changing strategy, restructuring, paying down debt, moving them into different companies, whatever it may be, then that's what you have to do. Business is business, right? You've got to sometimes pivot, change and adapt. And property is no different. Don't get too caught up in what if this and what if that. You just crack on. That's my view of everything. Regardless what the economy does, tax changes come in, government policy comes in, I just crack on and do my thing. And I'd strongly advise that you do the same. So those are the 4 main risks in property investing. There's the market volatility, and there's the economic changes, things like recession happening that you can't really control, but you can mitigate a little bit. There's a liquidity risk by putting all your money into one deal. You're going to be stuck. There's the tenant risk. As if they do something, they damage the property, there's voids, evictions, whatever, there's that risk. And there's tax change risks as well. Now, there's all 4 negative things about property. There's an abundance of positive things about property too. You know my views on property. I heavily buy property. I'll always buy property, I think. I'll always use my businesses to make money, and I'll invest the profits into property. The profits from my property will buy more property. And then eventually, at some point in my career, in my life, I'll take a step back from a lot of the businesses and I'll live off the property income properly. Maybe have some of the, I will have some of the coaching and mentoring still going because I love it and it's going pretty good. So those are my 4 risks. I hope you've learned something. I hope it's helped you in some way. If you know somebody that's one of those people that's really risk averse and they're thinking, oh, well, I don't want to do property for this reason or that reason, share this podcast with them, because hopefully it'll put their mind at ease. Yes, there are risks, but there's lots and lots of positives too. And once you actually look at those risks, like, they're not that bad in comparison to some investment vehicles, right? Putting all your money into a stock, you could lose every single penny of it. Putting it in crypto, it could go to zero. Yeah, it's less risky buying property. And having money in the bank, you're getting little to no interest, and that's actually risky too. Because do you trust the banks with your money? Because I don't. But share this podcast with them if you think it'll help them. And remember, don't just take notes, take action.